Stock market today analysis for Friday, January 6th, 2023. We're going to take a look at the overall markets that I consider to be the U.S. markets. Then we'll look at the 12 main sectors of the stock market. Maybe take a quick peek at interest rates and whatever else might fit the fancy. But that is the general plan for this video. Before we get into that, I'm going to let you know that there is a link in the description of this video to ihavesuccess.com. You can see the mission of I Have Success is to help you begin your trading journey by learning how to sell cash secured put options. Why cash secured put options? Because at contract expiration date, when you're selling a cash secured put option on a stock that you don't mind owning, at expiration date, it does not matter what happens. When you're doing that, two outcomes. Only one of two outcomes will happen. One, you make money because the contract will expire worthless and you'll keep the premium you received. The second outcome, you make money because you keep the premium, and you purchase an asset at a price that you knew that you might purchase it at. More than likely, it's going to be at a discount to the price it was at when you sold this option. So number one, you make money. Number two, you make money and you fill up your asset column. Isn't that quite fantastic? I believe it is, and that is why I am telling the world, if you have a bank account, if you have an internet connection, if you spend money at least once a year, there's no legitimate reason why you shouldn't be doing this. So not only am I going to pass that message, but I need to do this in a way that allows myself to grow and improve in the process. Because if you want to master something, teach it. Yeah, I want to master cash secured put options. Sure. There's a lot more I want to master in the market. So, I'm doing my best. That's me. I want to read a little bit about my story. Feel free to. So in the description of this video, there's a link to that. There's also a link to a playlist. I think it's Option Trading for Beginners. Beginners is fully capitalized. Watch those 5 videos. That will give you the ins and outs of what a put option is, what a call option is, how to do the wheel strategy, what the wheel strategy is, how to do it, how to set up some charts, how to get an idea of what to do with those charts, and how to use the Yahoo Finance screener for free to screen for some potentially good deals, some potentially fundamentally good companies. Now, it's not the be-all end-all. There's more learning to do after watching that that playlist. Especially another thing that can be helpful with that playlist is downloading the cash secured put stock selection guide. 3 stocks I sell cash secured put options on, and just keep in mind these are not the only 3 I sell cash secured put options on, but these are 3 that I've been selling cash secured put options on for years, and it kind of give you an idea of why I like them. Nothing to do with fundamentals, just a general kind of pick. And maybe there's a little bit to do with fundamentals, but it's not like numbers or whatever. It's just kind of this overall broad look at it. And between this one and this one, you should be able to get an idea. And then when you combine that with the Yahoo Finance screener and you're looking at some more fundamental stuff, you should be able to figure out how to make a somewhat wise decision on regarding doing a trade, which is selling the option, to potentially having an investment, which would be buying the asset, the paper asset via stock. There's one more step though. Once you kind of understand it in theory, get yourself a simulated trading account and practice. Just like the first day in boxing that you wanted to box, you wouldn't step into the ring with Manny Pacquiao. You'd punch the bag first. You'd do a little bit of, you'd do these other training things. You'd work your way up to fighting Manny Pacquiao. You want to start with him. And when it comes to the stock market, right? With Manny Pacquiao, you know who you get into the ring with. Unfortunately, with the stock market, you don't know who you're in there with. There's only one stock market. Have you ever heard that Warren Buffett owns some stocks? Well, if you're buying or selling a stock, how do you know the person on the other side of the trade isn't Warren Buffett? How do you know it's not Ray Dalio's crew over at Bridgewater? How do you know it's not Mark Minervini? How do you know it's not Andy Tanner? There's a lot of unknown professional traders in the world that they don't work. The job that they do, the way that they support their family, pay all their bills, is from these markets. They're trading gold contracts, whatever. They're trading SPX. If you're trading Amazon, they can be trading Amazon too. How do you know that your money's not necessarily being transferred to them? If you're just starting out, it's like, you know what they say about poker. If you look around the table and you don't know who the patsy is, it's you. Same thing with the market. If you don't know who the patsy is, it's you. So I don't mind being the bearer of bad news. Here's the bad news. Everybody's out to steal your money. Whether it's stealing or not, everyone's out to get your money. They might smile, they might have fancy suits, they might pretend they're not. That's the reality of it. And there's only one person that cares a lot about your money, and that's you. So I'll pop right here. I'll pop this in at 6 minutes and 45 seconds. Get ready for it. Here it comes. Boom! 6 minutes and 45 seconds. I got that for you. And that is a video on 5 reasons, not how to sell cash secured put options, but why you should be selling them. So let's blast through this relatively quickly because, my friends, it's Friday night. And I got some things to do after I make this video and get it uploaded onto the places it's being uploaded. Look at this, UUP. Boom, look at that drop. Now, we had been looking at UUP for a while, but I don't remember exactly when it was, but I talked about this potential, channel that it looked like it was in. Not the best. I'm not the best channel. Ooh, don't want to do that. I'm not the best channel drawer. Is that what? Doesn't even seem like it's right there, but somewhere in there. That one's not very good. But you see this one, right? It really kind of popped up above that, right? But now, boom, it came right down to that. So what's it going to do? Is it going to bounce off the top of that channel, or is it going to bounce back up, or is it going to come down? I'm not sure. UUP is $1. So there's certain things that you can trade that they are, political deals. Dollar is definitely a political deal. So I don't know. What does the government want? Does it mean they'll automatically get it? Not necessarily. There's other forces at play. But for example, maybe a stock like what would be an example? Maybe like maybe H&R Block. Maybe the government really just doesn't care much about H&R Block, right? They bring the government money, great. It's sort of like it's something that people don't really think about too much. But the dollar, the government probably cares about that. There's going to be other companies that, like, Hanes, Fruit of the Loom, people that make underwear or whatever. Does the government really care too much about that? They can be manipulating, either helping to push up per their agenda or push down per their agenda. Probably not. They probably don't care about a stock that makes ketchup or laundry detergent or something like that. But the dollar, other things, gold, yeah, they care about that. Speaking of something in between the dollar and gold, it's TLT, 20-year treasury bonds. That's another thing in the government's wheelhouse. Boom, we see it had been going down. Boom, now it's kind of going up. So what has tend to be happening for, I don't know how long exactly, but it's kind of been like whatever TLT is doing, not the actual interest rates, but whatever you see these candlesticks doing, the market has kind of been following. And it doesn't, always play out that way, but you can kind of watch it as a reference. So 20-year treasury started going up yesterday. It was a down day. Boom. And today, boom, all across the board. Gold. All right, look at this. Look at that candle. Just totally engulfing this one. A case in point though, is that when you see this engulfing candle, and what I mean by that is look at where the body of this one is right here. So the body of this one engulfs the body of this one. However, it would be a lot more bullish if not only if it engulfed, but if it started like right here, like if it was pushing way up here. So this is what's happening here is this day was real up. This day, boom, drops all the way down here, right? You can see it open there. That's where the bar is wider, the candle's wider, and then where the skinny part is, that's it traded in that range. But there's the open, there's the close. How do I know this end is the open? Because it's red. And now over here, the open is here, the close is here. How do I know that this end is the open and this end is the close? Because it's green. Generally speaking, the charts are set up. If you don't set them up this way, I don't know why you wouldn't, but generally speaking, green means up, red means down. If it's red, it closed lower than it opened. If it's green, it closed higher than it opened. And so we see what happened was how gold, see somewhere in here, you know, where the exact top of that straight line is, I'm not sure, but somewhere in there, right? There's like this straight line that it was, and maybe it's not a straight line, but it's like, it's this range where, see, it was kind of testing this range, but it wasn't able to break out from it. And while that was going on, look at what was happening down here. See how the prices kept moving up, but it wasn't moving up here. And then a lot of times what happens is when this pressure keeps pushing against this flat area here, prices can, boom, pop up this way. Now, because it's on the 200-day moving average, because it's on the top side of the 200-day moving average, it would indicate that maybe we're going to see that happen. The 200-day moving average is sloping down, but let's say if it was on the top of a 200-day moving average that was sloping up like this one, then we would think like it would be more probable that it was going to go up. But it seemed fairly probable. But anyways, that's what we see happening with gold, and that looks pretty bullish at the moment. But again, gold is a political animal, and we'll see what happens with it. But there's other forces at play in there. Oil basically, look at that, is almost just gone sideways over the last month below this downward sloping 200-day moving average. But it seems to kind of, yeah, look, in the last month staying above, basically above 70, pivoting right at the 70 and going back up above 70, but kind of below 80 in that trading range. Bitcoin continuing to be boring. I still hear people with these like kind of wild debates all over on Bitcoin. You know, Bitcoin's going to 200,000. Bitcoin's going to zero. We'll see. I don't have a dog in that fight, and I don't see any reason why Bitcoin just kind of can't flutter around like, you know, between 18 to 16,000, maybe a little lower, maybe a little higher. But why does it have to go to the moon, and why does it have to go to the other side of the earth? Maybe it can just kind of exist. We'll see. VIX. VIX, we see it drop down. Was up here around this 23, dropped down to a little bit under 21. It's generally when you see the VIX going down, you'd see the market moving up, and we see the market moving up. But you know what, my friend, she got all excited. She said, "Oh, it's an up day today. Look how much an up day it is." Okay, that's true. That's a big candle. That's a big candle. That's a big candle. That's a big candle. But take today's price action and put it in relationship with everything else. 4 major indices of the stock market. Where's the price action been? We're just taking a snapshot, looking at the last month, 1-day candles. Where's the price action been? Down or up? Down. How about this one? Down or up? Down. But it's like down like that right now. But overall, you see the price action. It's been down. How about this one? Down. How about this one? Down. Where is the price action? We know the direction. All the price action has been moving down. Where is it in relationship to its 200-day moving average? Below a downward sloping 200-day moving average. Below a downward sloping 200-day moving average. Below a downward sloping 200-day moving average. This one above a sideways 200-day moving average. Now looking at it in that context, this one candle, what makes you think all of a sudden the whole stock market's going to change directions because there was one big candle like this? Sometimes it's wise to look at a bigger picture. That's why on Sunday I'm going to post that weekly chart review. We're going to look at weekly charts, some monthly charts, and seeing a bigger picture. Even if you're not looking at a weekly chart, just seeing a bigger picture, right? It's not like, oh, just try to see a bigger picture. Like the 200-day moving average is interesting because it's average of pricing of 200 days, right? Gives you a longer term trend. Let's take a peek at the 12 main sectors. Now, some people say 11, and maybe 11 is, maybe that's all there is, but I was able to find 12, so we're looking at 12. Plus, it makes it like, you know, a little neater and organized right here. It's not like I have any, everything's the same size box. I'm guessing most everything's going to be up. I haven't looked. Everything up, everything up, everything up. There you go. Everything up. Why wouldn't we expect it to? Because we saw all four of the main indices moving up. And but one candle doesn't not make a trend. So we'll take a look at this before we look at interest rates. All right. What do you see? That's a pretty good sign, right? Well, it's not a good sign if you're shorting. Maybe it is a good sign if you're shorting. If you want to add more, I don't know. You know, it depends on your perspective. So that's one thing when people are saying it's good, it's bad. Like, what's their perspective? Are they in a bunch of long positions? So what's good is when the stock market goes up. If they're in a bunch of short positions, what's good is the stock market goes down. What if they got a bunch of iron condors and want the stock market to go sideways? Where is it in relationship to the, you know, their strikes? So put it in the context of what's going on. But what for me, I'm seeing more evidence of kind of like a trading range through here and possibly through somewhere in here. And I think that it's wider. I think that it can be wider than that. I think we're got a trading range of like this. Now, exactly where is it at? I'm not sure. You know, I tried using that really straight line, and it's just kind of easier to do this little bit of unstraight line, because I think that's more of how it is. It's not this exact price point, you know, 400. You know, it could be anywhere from like, it's kind of in this range from somewhere like 380 to 400. That's $20 difference, right? So this kind of this range with a little bigger one. Now, if we see something like breaking to the upside past this 420, which I know that's, some people are laughing, like that's some people's favorite number. Or if we see this break to the downside, right there, look over here, look over there when I put it there, right? Now some people like 420, some people like 357. Whatever your favorite number is, I don't care. Stock market's delivering to you. All ends of the spectrum. They got all the spectrum. They got the 420 people all the way to the 357 people covered. That's why the stock market's great. It's for everybody. It's for every human being. So if it breaks below this or above that, you know, I don't know. Maybe you don't know. But I think we might grind sideways. I think we might kind of, if we break out, like, let's see, can we do a different color? What's this color over here? Let's try this color. Maybe it kind of goes. But if it's doing that, where's it really going? If it keeps doing this, where's it really going? It's going sideways. If it keeps doing that. Now, when we looked at, let's take another look at right here. So, looking at this real quick, let's count how many sectors of the market are below a downward sloping 200-day moving average. Okay, 1, 2, 3, 4, 5. It used to be 6. Now, paying attention to this stuff, isn't that it? That's something that you can know. So that is now. Isn't that good to know that it used to be 6? It used to be 6 out of 12 were very bearish, right? To that downward slant. What is it? Maybe it's this one. Maybe it's XLF that's now above. Okay, now how many? Let's say how many are above an uptrend 200-day moving average? Well, it's kind of an uptrend, right? I mean, yeah, I can't really count this one or this one as an uptrend. This one, I think this is possibly more. So let's just, I guess, give it the benefit of the doubt. We got 1, 2, looks like it to me. Yeah, that kind of looks like it. And then how many are dealing with a sideways? 1, 2, 3, 4. So if we are going to, so a couple things we want to keep in mind, right, is that here's one of the big things is in order to really be a bull trend, in order for it to be going back up, it needs to get past different resistant areas. So right now, one of the first layers of resistance is going to be probably kind of like something like kind of like here, 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 something in this area, something like that. And then see that top right there, see that top right there. This one's a little bit higher. Now looking over to the left, look at that, we see that here, right? It's almost going straight across. Nothing really over to the left. So we've got that on the upside. And then look at this, right in here, look at that. Probably something along that range right in there. So it seems like it's got some, some battling to get above that. But if it's going to do that, what more than likely we would need to see, at minimum, more of these downward sloping 200-day moving averages maybe turn into sideways. Well, here's what we really have to see. Here's the first thing, because getting the 200-day moving average to change is longer, right? Because it's average of 200 days. But your daily candle, you're going to see these daily candles continue to move up. So for example, this one right here, right? It was over here, fell below that 200-day moving average, right? Now today it just popped up above it. So if this one continues to close above that 200-day moving average, right now, look at it, it's just starting to slope down just a little bit. It looks sideways, but we're seeing that it's kind of starting to go into a downward sloping 200-day moving average. So if this stays above the 200-day moving average, that's going to be good. Okay, we need this one to stay above the 200-day moving average, which it is. But if it has this failure, it tried to break out of this range. I'm sure you can see that. See this range right there. Something along those lines. If it fails and it comes back down here, I mean, it could go back up again, but it could, potentially go lower. XLF financials, that one's definitely got to stay broken out and above that 200-day moving average. We need to see this one kind of start moving up closer to that 200-day moving average. Oil, we probably or whatever, energy probably needs to stay above there. This one, right? We need to see this going up here. We need to see this one stay above. We need to see this one get above. We need to see this one move above. We got to see it get above this area right here. This guy's got to get above that 64. You know, and this one, it's already kind of, potentially it's got to stay above this, but it's got to get right in there. That's the last place it kind of had this pivot right there. This one's going to have to basically break out above this 82 and then the 84. And then I think you can kind of see that. It's just like you see where these levels are, where price action has traded before, and so we're getting a lot of sideways stuff, right? And if it keeps going sideways, then we will see on this more sideways movement. If it's going to keep going up, then eventually we'll see it keep going up. And so by watching these different things, you should have an idea of what's going on. And what's great is that when you start having an idea of what's going on, you don't have to believe what the people on TV are telling you, because more than likely the people on TV, you don't have dinner with them. More than likely at Thanksgiving, they don't call you, they don't invite you over their house, you don't call them, you don't invite them over to your house. More than likely, if you get married, your daughter gets married, whatever, your son gets married, more than likely they're not coming to your wedding. You probably don't even know their number to call to invite them to come to the wedding, or whatever, the address to send it to them. These people have no connection with you. They're just some random people on there. And unless you know exactly who's paying them and what they're paying them to do, why trust them? Why leave your hard-earned money up to the opinions, the suspect opinions of random strangers? Just because they have a fancy shirt, fancy suit, nice haircut, and $40,000 teeth in their mouth does not mean they care about you. Doesn't mean that. So let's look at those interest rates. Where is that at? And we'll look at those interest rates. Yeah, let's take a look at those. All right, these are weekly line charts for 1 year. So we're seeing a good amount of data. We see they've all been going up, right, over the last year. Up, 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 up. You get the picture. 10-year. Where's the 2-year? Right here, 2-year. So right now, if you hear people talking about yield curve inversion, this is an example of what they're talking about. And it seems like this 10-year and 2-year are one that a lot of these macro guys will look at. Don't hold it as a be-all end-all, right? I never claim to be some sort of macroeconomic guru. I try to listen to them and try to figure out what's going on. But anyway, so you're 2 years. If you loan the government money for 2 years, but based on this number, it's riskier. There's less people wanting to loan the government for 2 years. How do we know that? Because they have to pay more. Like, for example, let's say you own a business and you got a job that nobody wants to do. You could potentially raise the amount of money you're paying until you finally get someone that wants to do the job. They say, okay, for this amount of money, I'll do the job. Right? That's basically how it goes. If you got a job that someone doesn't want to do, that people don't want to do in general, you're not getting people to interview for this job. The people that you do get to interview, they won't stick around. You know, basically you cannot keep this job filled. And let's say you're paying like $20 an hour. Well, you know, maybe you double it. Maybe you don't double it right at first, but maybe you do for some reason. All of a sudden, you see, are you getting people to stick around? Are people willing to do this work? Are people willing to risk wasting their time at your job? And you might think like, it's not a waste of time, blah, 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 blah. Look at it from their perspective. Think about this treasury. Are people willing to waste their time and money? Opportunity cost. They're going to put their money in here for 2 years. You got to give me something I like over it. But over here, over at 10 years, for some reason, I'll give you a longer loan, and I feel like there's less risk in this longer loan. But for the shorter loan, where I know I'm going to get my money back, you're going to have my money for 8 years longer. There's 8 years more problems that could go on. But I'm okay if you pay me less for 10 years, but you got to pay me more for 2 years. So they call stuff like that yield curve inversion. And generally speaking, I guess it just signals that there's going to be some rough stuff in the economy, which I don't know. When I look around, I I see the rough stuff already. It looks like the rough stuff has already been here. So if people are like, oh, it's going to be in the future, like, well, I don't know. I'm not sure how many restaurants you've seen close around your place, but I see a lot of restaurants close around mine. I see a lot of people, like, I see a lot of empty seats in restaurants. I don't see an economic boom going on. Down here is showing the S&P SPX S&P 500 index against the 10-year Treasury, and we see overall. And look at this right there, right? That little. How easy can you see that? I don't know if my cursor disappears, but look at how the green started going down, and that purple started going up. So a lot of times, they're moving inversely. And these are different ETFs that represent like 1 to 3 years. I think like 3 to 7 or something like that. 20 years. With TLT, we looked at that. And this one, like 20 to 30 years. As the rates go up, the value of these go down. Just like in our job example. Why would you have to pay someone a lot of money to do this job? Because nobody wants to do it. It's not a valuable job. People don't like it. I've definitely have worked in an industry that nobody wanted to do. It's like a job that has no prestige. So it was harder to get people. Like, you kind of have to pay people more to do this kind of job that they don't want to do it. And that's how it is. So how can you use this as like implement it right now? I've been wondering that for a long time, because I hear these macro guys talking about this. I'm like, okay, well, what do I do? What do I do this week? What do I do this month? So I think overall, there's probably more, but real basically, you can pay attention to the 2-year and the 10-year. If you see the 2-year giving a higher interest rate than the 10-year, and it continues to do that, then maybe one thing that you could do is be a little hesitant be more cautious when you're going long stock. Doesn't mean don't go long, but be a little more cautious. Like, if this is indicating rough financial stuff ahead, maybe we're already in it. Maybe this is the extent of it. I don't know. But maybe if you're selling, cash secured put options to acquire stock, I don't know if this is your stock's trading here. Usually maybe you're selling down here. Maybe you go a little bit lower just in case there's a pullback. Yeah, does that mean you don't get as much premium? Potentially. It potentially does. It doesn't always have to be if you time it right, but potentially it does. But what it also is going to do is that if there is a drop in the stock market due to some whatever black swan economic event, then you're going to get filled. If you get filled at that strike price, it's a lot better than getting filled up here and have the stock trading down here, right? So that's something that you could potentially do. And ultimately, as I mentioned before, paper trade. When in doubt, put the trade on, but do it in your paper account. All right, say it with me. When in doubt, put the trade on, but do it in your paper account. I'll practice it. We'll get a little rhythm going. Maybe maybe 5 of us can get together and form like a glamour band. Like men over 40, new 40 plus men on the block, something like that, and we can do our little song and dance, and have our songs be about trading, and that's the kind of music that I'm into. So with that, my friends, I'm gonna go start practicing my dance routine for that new band that we're gonna be coming out with. Please drop off your resume in the comments below, and you guys have a fantastic weekend. Aloha.